Let me start with a warning that most investors are not prepared to hear. The biggest threat to your portfolio is not a market crash. It's not a recession. It's not even bad timing. The real danger is what you already own. Right now, millions of people are holding assets they believe are safe, assets that feel responsible, assets that advisors recommend, that headlines praise, and that seem sensible on the surface. But these same assets are quietly destroying portfolios, not in a dramatic way, not overnight, slowly, silently, year after year, and that's why they're so dangerous. When something collapses suddenly, people react. When something erodes quietly, people ignore it. By the time they realize what's happening, the damage is already locked in. If you care about protecting your future, you need to understand this now, before comfort turns into regret. Most investors define safety the wrong way. They think a safe asset is something that doesn't move much, something that doesn't scare them, something that feels predictable. But stability is not protection. An asset can look calm on the surface and still destroy your purchasing power underneath. That's the illusion most people fall for. And the first asset doing this to portfolios everywhere is one people defend aggressively because it feels smart. Cash. Cash feels safe because the number doesn't go down. You open your account and it looks the same. No volatility, no headlines, no stress. But that calm is deceptive. Cash is not neutral. It is actively working against you. Every year, inflation quietly reduces what your money can buy. Your effort stored in cash loses value without making a sound. You don't see red numbers, so your brain assumes nothing is wrong, but something is very wrong. Holding large amounts of cash for long periods is not conservative. It is a guaranteed loss in real terms. People say, "At least I'm not losing money." You are. You're just losing it invisibly. Cash has a purpose: liquidity, emergency access, short-term flexibility. But cash is not a long-term store of value. Treating it like one is a mistake, and a costly one. The most dangerous part is psychological. Cash makes people feel in control. It creates the illusion of safety, while disciplined investors quietly compound ahead. While one group feels calm, the other group gets ahead, and over time, that gap becomes permanent. But cash is only the first problem. The second asset damaging portfolios is even more dangerous because it's been marketed for decades as responsible investing. Long-term bonds. For a long time, bonds earned their reputation. They provided income, they reduced volatility, they played a role. But markets change, and investors who cling to old rules get punished. Long-term bonds are extremely sensitive to interest rates. When rates rise, bond prices fall, and they don't fall gently. Many investors learned this lesson recently, watching what they thought was the safest part of their portfolio suffer heavy losses. But the real danger isn't just price movement, it's being locked into low returns during high inflation. When inflation is elevated and you hold long-term bonds yielding less than the inflation rate, you are guaranteeing a loss in purchasing power. Not maybe, not potentially, guaranteed. Year after year. That's not safety, that's slow destruction. Investors chasing safe income often sacrifice growth without realizing it, and the cost isn't visible right away. It shows up years later, when compounding didn't happen, when retirement projections fall short, when time cannot be recovered. That's the trap. Bonds are not evil, blind allocation is. Which brings us to the third asset, the one people defend emotionally. Because this one feels productive, it feels tangible, it feels like real work. And that asset is over-concentrated real estate. Real estate itself is not the enemy. Belief without analysis is. People repeat the same phrase confidently: real estate always goes up. It doesn't. Real estate goes up sometimes in some places under specific conditions. But when too much of your net worth is tied to one property, one city, One market cycle, you lose flexibility. You can't rebalance, you can't move quickly, you can't respond to change. Liquidity disappears, and liquidity is protection. Many investors focus on rent coming in, but ignore the full picture. Maintenance, taxes, insurance, vacancies, time, stress. Net returns are often far lower than expected, and when leverage is involved, mistakes are amplified. Debt feels smart when prices rise. It feels brutal when conditions stall or reverse. Over-concentration is not diversification. It's risk disguised as confidence. And when investors realize this, it's usually too late to exit cleanly. Here's the part most people miss. None of these assets are bad by default. The danger comes from misunderstanding them, from holding them for the wrong reason, from over-allocating out of fear, from confusing comfort with protection. True portfolio safety doesn't come from avoiding volatility. It comes from understanding risk. Because risk doesn't disappear when you avoid markets, it simply changes form. Cash risk, inflation risk, opportunity risk. Avoiding visible risk often guarantees invisible loss. In the next part, we'll talk about what actually protects a portfolio and why most people never build it. Now that you understand which assets quietly damage portfolios, we need to talk about something even more important: why people keep holding them even when the evidence is right in front of them. Because the real problem is not information. The real problem is behavior. Most investors don't make decisions based on logic. They make decisions based on comfort. Comfort feels safe. Comfort feels familiar. Comfort feels responsible. And that's exactly why it's dangerous. When people hold too much cash, they tell themselves they're being cautious. When they cling to long-term bonds, they believe they're being conservative. When they pour everything into real estate, they feel productive and smart. None of these feelings protect a portfolio. They protect emotions. And portfolios don't care about emotions. They respond to structure, discipline, and time. Here's something most people never stop to consider. Risk is not something you eliminate. Risk is something you choose. You can choose visible risk, like market volatility, or you can choose invisible risk, like inflation and opportunity cost. Most people choose invisible risk because it doesn't cause anxiety today. But invisible risk compounds silently. Every year you avoid intelligent exposure to growth, you don't just miss returns, you miss time. And time is the only thing money can never replace. This is why two investors with the same income and the same starting point end up in completely different places. One understands this trade-off. The other avoids discomfort. One builds a portfolio designed to adapt. The other builds a portfolio designed to feel calm. Calm is not protection. Adaptability is. And adaptability requires understanding how assets behave in different environments. Markets do not move in straight lines. They move in cycles. Interest rate cycles, inflation cycles, growth cycles, fear cycles. Assets respond differently in each one. Cash loses quietly during inflationary periods. Long-term bonds struggle when rates rise. Over-leveraged real estate suffers when liquidity tightens. These are not surprises. They are patterns. But patterns are only useful if you respect them. Most people don't. They anchor their beliefs to what worked in the past and assume it will protect them in the future. That assumption is costly. The most dangerous sentence in investing is, "This has always been safe." Nothing is always safe. Safety is conditional, and conditions change. This is where most portfolios fail, not because the investor made one terrible decision, but because they never adjusted. They held on to assets long after the reasons for holding them disappeared. They confused familiarity with security, and familiarity is comforting, even when it's harmful. Another major problem is overconfidence. People believe diversification means owning many things. It doesn't.
Diversification means owning assets that behave differently under pressure. Owning multiple assets that all fail under the same conditions is not diversification. It's concentration with extra steps. Holding cash, bonds, and real estate can still be dangerous if they're all vulnerable to the same forces: inflation, liquidity shocks, rising rates. This is why surface-level diversification fails. True diversification requires understanding correlation, not labels. It requires knowing what happens when conditions change, not just when things are calm. And here's where advisors often fail people. They sell models. They sell averages. They sell comfort. They rarely sell uncomfortable truth, because uncomfortable truth is harder to market. It requires discipline, it requires patience, and it requires accepting short-term volatility for long-term stability. Most people don't want that. They want reassurance, so they get portfolios designed to reassure them, not to protect them. And reassurance is expensive. Another issue most investors underestimate is sequencing. When returns happen matters as much as how much returns happen. A portfolio that underperforms early on loses compounding momentum. You don't get that time back. Holding low-return assets for too long early in your investing life does permanent damage. It reduces what later gains can build on. This is why playing it safe for too long is one of the most dangerous strategies of all. Safety delayed growth. Delayed growth delays freedom, and delayed freedom often never arrives. Most people only realize this when they start doing the math later in life. They look at their balances, they look at their timeline, and they realize something doesn't add up. At that point, panic replaces comfort, and panic leads to bad decisions. Selling at the wrong time, chasing returns, overcorrecting. The cycle repeats. This is why discipline must come before emotion. A well-designed portfolio is boring. It doesn't chase headlines. It doesn't react to every fear. It doesn't require constant attention. It is built with intention. It balances growth with protection, liquidity with compounding, flexibility with patience. Most importantly, it is built with a clear understanding of why each asset exists. If you can't explain why you own something, you shouldn't own it. Hope is not a strategy. Comfort is not a strategy. Tradition is not a strategy. Understanding is. Another hard truth most people avoid is this: doing nothing is a decision. Holding cash while waiting for clarity is a decision. Staying overexposed to assets that no longer serve you is a decision. Indecision has consequences, and those consequences compound just like returns do. The market doesn't reward caution, it rewards preparation. Preparation means accepting that volatility is the price of admission for growth. It means understanding that avoiding short-term discomfort often guarantees long-term disappointment. It means being willing to look wrong today in order to be right tomorrow. Most people cannot tolerate that. They want to feel right now, and that desire costs them later. In the next part, we're going to shift from diagnosis to control, because knowing what destroys a portfolio is only useful if you understand what actually protects one, and more importantly, how disciplined investors think differently, not emotionally, but structurally, because portfolios don't survive on good intentions, they survive on intelligent design.
At this point, the most important thing to understand is this. Protecting a portfolio is not about finding the perfect asset. It's about building a structure that can survive change. Markets will change. Interest rates will change. Inflation will change. Narratives will change. What destroys portfolios is not change itself, it's rigidity. Most people build portfolios that only work in one environment. When that environment disappears, so does their confidence. That's why control matters more than prediction. You don't need to know exactly what will happen next. You need a portfolio that doesn't break when you're wrong.
This is where disciplined investors separate themselves from emotional ones. They stop asking what feels safe and start asking what adapts. Adaptation requires three things: balance, liquidity, and discipline. Balance means no single asset dominates your future. Liquidity means you can move when conditions change. Discipline means you don't abandon the plan when emotions spike. Most people fail on the third one. They understand the logic, they agree with the strategy, but when fear shows up, they abandon discipline. Fear during market downturns, greed during rallies, comfort during long stretches of calm. Emotions never disappear, they just change costumes. That's why rules matter. Rules remove emotion from decision-making. A disciplined investor operates with rules, not feelings. Rules like not letting cash sit idle beyond its purpose. Rules like not over-allocating to income assets that lose purchasing power. Rules like not allowing one property, one sector, or one idea to dominate the portfolio. These rules feel restrictive at first, but restriction is what creates freedom. Freedom is not the ability to do anything you want. It's the ability to survive bad periods without panic. And panic is the real portfolio killer. Panic makes people sell at the wrong time. Panic makes people chase what already ran up. Panic makes people abandon long-term thinking. A controlled portfolio is designed to reduce panic, not eliminate volatility, reduce emotional reactions to it. That's a critical difference. Another thing disciplined investors understand is this: every asset has a job. Cash's job is liquidity, not growth. Income assets' job is stability, not dominance. Growth assets' job is compounding, not comfort. When you expect an asset to do a job it was never meant to do, disappointment is guaranteed. Cash is not meant to protect you from inflation long term. Bonds are not meant to create wealth. Real estate is not meant to replace diversification. Once you accept this, allocation becomes clearer. You stop chasing narratives and start managing roles. And that clarity is powerful. Most people don't manage roles, they manage feelings. They add assets when they feel safe. They remove assets when they feel afraid. That behavior guarantees underperformance, because markets reward consistency, not emotion. Another critical concept is time alignment. Your portfolio must match your timeline. Short-term money should not chase long-term returns. Long-term money should not hide in short-term safety. Mixing timelines creates confusion and bad decisions. People panic because they invest money they need soon. They underperform because they protect money meant for decades. Clarity of timeline reduces fear. Fear comes from uncertainty. Uncertainty comes from poor structure. This is why disciplined investors spend more time designing their portfolio than watching it. They don't check prices constantly, they check alignment. They ask, does this still make sense? Not, how does this feel today? And here's the part most people avoid. There is no point where investing becomes emotionally easy. There is no level of wealth where fear disappears. There are always stakes, there is always uncertainty. The difference is not the absence of fear, it's the presence of control. Control comes from preparation. Preparation means accepting that losses will happen, drawdowns will happen, periods of underperformance will happen. If you cannot accept that, no portfolio will ever feel safe. Trying to eliminate all downside guarantees long-term failure, because upside is the reward for tolerating downside. This is why chasing safe assets often produces the most dangerous outcome: permanent loss of purchasing power. Slow losses don't trigger alarms, they just quietly shrink your future. And when people finally notice, time is gone. This is why education matters. Not in education in the sense of complexity, but clarity. Understanding what you own, why you own it, when it works, when it doesn't. Ignorance forces emotion. Investment enables discipline. And discipline compounds. Not just financially, but psychologically. Each time you stick to your plan during uncertainty, confidence grows. Each time you avoid panic, trust builds. That trust becomes an asset. It allows you to stay invested when others quit. It allows you to rebalance instead of react. It allows you to think long-term in a short-term world. This is where real portfolio protection comes from. Not from avoiding risk, but from understanding it deeply. Not from hiding in assets that feel safe, but from owning assets that work together. Not from prediction, but from preparation. At the end of the day, there are only two types of investors: those who want comfort now and those who want control later. Comfort is seductive. Control is earned. Most people choose comfort because it feels responsible. But responsibility without results is just delay. If this video challenged the way you think about your portfolio, that's a good thing. It means you're asking better questions, and better questions lead to better decisions. Leave a comment and be honest. Which asset do you feel most exposed to right now? Like this video if it helped you see risk more clearly. Subscribe if you want calm, honest, no-nonsense thinking about money. Because wealth is not built by avoiding danger. It's built by understanding it and staying disciplined when others don't.